People have always looked to game the markets, and right now the best way to do that is using technology.
When there were humans completely in charge, people were getting ripped off, right? So is it better or worse now?
I'd say it's different. It's different because it's not happening human to human, it's happening with a computer. And I think it actually makes it slightly more dangerous when it's not happening human to human, because people feel, I think, more cavalier with how a computer treats someone versus a human treating someone else. People are always looking to game the system. And in today's market, that's happening through technology. So I think that for us, it's about keeping all the good things that technology has brought, but also looking to use technology to eliminate some of that scalping that we see happening.
We know that fewer than half of Americans actually invest in the stock market. They're really getting screwed because they were not even in the stock market last year. I mean, do you worry about that all of this publicity around the book is actually pushing people away from the stock market, which could hurt them in the long term?
We've gotten thousands and thousands of messages and calls. If anything, it's done the opposite. It's given people, I guess, the belief that there are people in the market that are looking out for their best interests. If it has scared anyone away, I'll be the first to apologize. I think the fight within Wall Street is people who are embedded in the status quo and people who believe that change needs to happen. To think that we've actually damaged the credibility of Wall Street any worse than it's done to itself over the last 10 years, I think is kind of funny.
There's just kind of this kind of blind faith in investing and saving, but not really knowing how much you're supposed to have. And most people just don't have the financial literacy for the basics. And then you go into the complicated architecture of financial markets, and it gets even more difficult.
When you look at the number of places that exist to trade, I mean, if there's only a single exchange, it'd be really hard for intermediaries to get in between buyers and sellers. There are 58 places to trade right now in the United States. Everything but New York Stock Exchange and NASDAQ, which are both public companies, all of the other ones have been started by intermediaries, by middlemen. So what that does is it skews the incentive structure more towards the intermediaries, and it places the traditional investor farther away from the point of the transaction. You talked earlier about this blind trust people want to have in the market, where they know a little bit, and they just trust that the system works. And I think the biggest part about that is that trust has been broken. The market should just really be a neutral place where buyers and sellers can meet, almost like the referee, right? You hope that when you watch the NFL game that the referee is not skewed for one team to win versus the next.
For the average investor buying a mutual fund, or the average investor who maybe has a small account on E-Trade and maybe has a 401k through Fidelity, should they be concerned, or is this something that only affects customers with very large trading volumes?
Everyone in some way, shape, or form is an investor. So whether you're big or you're small, the problems still exist. And I think it's our job, number one, to raise the level of education amongst all investors so that they can make better decisions on how their orders are handled.